My name is Farhan. Today you will solve question 4 from 2014 past exam. This question requires you to prepare a classified balance sheet. This question has many complications, so make sure to focus and follow through the entire content for an excellent understanding. With that being said, let's get started. Chris Stone established a small business, Willow Terrace, to sell outdoor furniture. The business will use control accounts and subsidiary ledgers for both debtors and creditors. The business officially commenced on 1 June 2014 with the following transactions and information. So we are given a list of transactions that you need to incorporate in your workings and prepare the classified balance sheet as at 1 June 2014. So we understand that the accounting equation is assets equal to the total of capital plus the total of liabilities, which means when we prepare the balance sheet, we need to show all the assets on one side, which can be broken down into current assets and non-current assets. And on the other side, we show the current liabilities, the non-current liabilities, and the owner's equity. So let's start with the first additional information that we have. So on the right hand side of the screen, you can get to see the workings. So what does the first transaction say? A check for $40,000 from Chris Stone was paid into the business bank account. Right. So this is the initial capital that Chris is using to start the business. So Chris deposited $40,000 into the business bank account. Because we're preparing the balance sheet for the business or from the perspective of the business, if you are depositing $40,000 into the business bank account, the assets of the business are going up. If we were to generalize this, we would debit the bank account. DR means debit. So we would debit the bank account by $40,000, which reflects an increase in current assets. At the same time, we know this $40,000 that we have injected into the business represents the owner's equity or the capital. So we are crediting capital by $40,000. What's the reason for debiting bank by $40,000 and crediting capital by $40,000? Always remember, when assets increase, which is what is happening when you are injecting $40,000 into the business bank account, we debit them. When assets increase, we debit them. And when assets decrease, we credit them. When capital increases, we credit them. And when capital decreases, we debit them. So that's the main reason for why we are debiting the bank account by $40,000, reflecting an increase in the total assets, specifically the current assets. And we are crediting capital by $40,000, which reflects an increase in owner's equity. Let's look into the second transaction. A business loan of $20,000 was received from any bank. The loan is repayable in equal monthly installments over 24 months. An overdraft of $15,000 was also arranged. All right. So let's look into the first sentence of the second transaction. So the business has taken a bank loan, which is $20,000. So we understand that loans are increasing by $20,000. All right. But we also understand that we are repaying this loan in equal installments over 24 months. This means that in the next 12 months, we are paying $10,000, and from month 13 to month 24, which falls into the second year, we are paying an additional $10,000 to repay off the loan fully. Now, if we are today at 1st of June 2014, and we know within the next 12 months, we are going to be paying off 50% of the original loan of $20,000, given that today we are at 1 June 2014, whatever our obligation is in the next 12 months will fit the definition of a current liability. And that is why the current liability portion for the loan that we have taken is $10,000, which is due in 12 months. And that is why this serves the definition of a current liability. Then we know that after 12 months, which is from month 13 to month 24, so after 12 months, which is in between month 13 to month 24, we are paying off the other $10,000. So that portion of $10,000 fits the definition of a non-current liability because it's not due within 12 months, but after the 12 months and will be covered in between month 13 and month 24. All right. So the original loan we have taken is $20,000, out of which $10,000 is the current liability portion due in the next 12 months, and $10,000 is the non-current liability portion, which is due after the 12 months in between month 13 and month 24 inclusive. So when you're taking the loan of $20,000, how should we reflect that within the journal entries? So we understand that we have two liabilities, which are taking the credit side of the journal entry, but at the same time, our assets are also increasing by $20,000 because when we are taking the loan, our bank balance is going up by $20,000. So what's happening is we went to the bank, we asked for a loan, we got granted the loan, and the bank deposited the money into our business bank account. All right. So when the bank deposits the $20,000 into the business bank account, our assets in the form of cash at bank goes up. So when assets go up, we debit it. So that is why we are debiting back by $20,000. All right. And the credit side of this journal entry is basically the two liabilities, the current liability of $10,000, referring to the short-term loan repayment, and the non-current liability being $10,000, referring to the loan repayment after 12 months in between month 13 and month 24 inclusive. All right. So this is what we have so far for point number 2. What about the second sentence for this transaction? An overdraft of $15,000 was also arranged. Also arranged. It's arranged. It doesn't mean it has been used. Today is 1st June 2014 when we are preparing this balance sheet. And to protect the business from any problems in the future, the business has arranged $15,000 of overdraft. This means if the business has no money left at some time in the financial year, the business is able to access $15,000 more from the bank account. So this hasn't happened yet. Okay, so we do not worry about this at the moment. This has no effect on any of the balance sheet things, which are assets, capital, and liabilities. So let's move to additional information number 3. A 3-year rental agreement was signed. Rent of $5,000 was paid for the 3 months to 31 August. And the source document is the check 001. All right, so based on the first sentence, we have signed a 3-year rental agreement. And how does this work in Australia? So if you're a small business, and given that you're signing a 3-year rental agreement, this refers to commercial use of the property. That's why you have signed the rental agreement, which is to sell the outdoor furniture. So because it's a commercial property, the rent that you will be paying also needs to include GST. All right. So the question doesn't explicitly mention GST. It just says that rent of $5,000 was paid at 1 June 2014, which covers 3 months up to August 31. All right. So check the right-hand side of the screen for all the workings. So we understand that prepaid rent at 1 June 2014 was $5,000. This is what we have paid today. And this rent is an economic benefit which has been prepaid and still not yet consumed by the business. So we cannot call this a rent expense. So this means this is what we define as a current asset because we expect to consume the economic benefits of $5,000 in the next 3 months. And those 3 months are June, July, and all of August. And because this property is for commercial use, which we have just discussed a while ago, the GST on rent is $500 that you need to calculate separately, and that is calculated by multiplying 10% on $5,000. Okay? All right. So let's read the second sentence. Willow Terrace paid a security bond of $4,000 with the source document being check number 2. The security bond will be refunded to Willow Terrace at the end of the rental agreement, provided that the premises are in satisfactory condition. So this is basically what goes on every time you rent something in Australia. So the security bond is going to be repaid at the end of the 3-year rental agreement. So at end of 3 year, all right? But you are paying it today at 1 June 2014, but you can get it back at the end of the 3 years. So this is what we define as a non-current asset. The reason this is a non-current asset is because the $4,000 that we are paying as security bonds, we can get to claim it all of it back at the end of the 3 years, given that the premises is in satisfactory condition. Because this is at the end of the 3 years, which is beyond 1 year, this is what we classify as a non-current asset, because the economic benefit of $4,000 is going to be stored within the security bond unless we do not have any damages within the property. So we are not assuming that at the moment. We're assuming this to have this economic benefit existing at the end of the 3-year rental agreement, and therefore this forms the definition of a non-current asset for the business. It's not liquid at the moment because you cannot access it, but it's just there as a security. All right. So how much have we paid in total, including the prepaid rent, the GST on the rent, and the security bond? So prepaid rent is 5,000, GST on rent is 500, and security bond is 4,000. So that makes it $9,500 that has been paid in total. And if I was to journalize this, I would be crediting bank by 9,500. All right. And if you are interested in what we would have debited, we would debit the prepaid rent by 5,000. We would also debit the GST clearing. The reason we can debit the GST clearing is because this is GST that we have paid, and therefore we can offset this when we calculate the GST settlement. And what else can we debit? The security bond. So that is $4,000. I know we are supposed to write the credit entry at the end, but just because we didn't have any space. So debit prepaid rent, debit GST clearing, debit security bond, and credit bank. All right. So this is how you would have formed it. All the journal entries for debits and credits. So let's move to transaction number 4. Chris's own motor vehicle, valued at $24,000, was also contributed to the business. It originally costed $52,000 plus GST. All right. So the transaction explicitly mentions own motor vehicle. So this was for private use before. And when it was purchased for private use before, Chris paid $52,000 plus GST. But today, at 1 June 2014, we are contributing this at fair value into the business, which is $24,000. And that is referring to the additional capital contribution apart from the initial deposit of $40,000, which you saw in the first transaction. Now, why are we not recording the motor vehicle within the business at $52,000, but at the fair value of $24,000? This is because of the accounting assumption of business entity or accounting entity concept, which says that only transactions that are relevant to business activities are actually taken into account for preparing the financial statements for the business. Right? So which means any personal transaction is to be kept separate. The day this motor vehicle was contributed to the business, that day the motor vehicle had a carrying value of $24,000 remaining, which is the fair value. And that's the value that the business can consume. All right. So that is why in the books of the business, we are going to be including this motor vehicle at $24,000. Right? So motor vehicle goes up by $24,000 in the books of the business, which reflects an increase in assets. And you would be debiting it to reflect that increase. And capital is also increasing by $24,000, which reflects the additional capital contribution in the form of motor vehicle. And if you were to journalize this, you would be crediting it. Okay? So let's move on to transaction number 5. Shop fittings that cost $30,000 plus GST were purchased on credit from BFIT. A deposit of $4,000 was also made. All right. So, based on the first sentence and the second sentence combined, let's see what's happening. So, the total cost of the shop fittings, including GST, is the original cost of $30,000 plus the GST, which is calculated at 10% of the original cost. And that is $33,000, with $3,000 being the GST out of this $33,000. Now we understand that the second sentence says that a deposit of $4,000 was paid. All right. So what's happening is that the total cost, I'm talking about the cost excluding GST, all right? So the total cost of the shop fittings is $30,000. $4,000 was paid today, and $26,000 was purchased on credit, which will be paid off at some point in time in the future. Okay, so let's take care of the $4,000 component first. So what's happening? So we debit shop fittings by $4,000 and we credit bank by $4,000. So when we do this, this is saying that we have used $4,000 from the bank account, which reflects a decrease in the value of the asset, but at the same time, this is paid off for $4,000 worth of shop fittings, which is also increasing the assets, but for shopping fittings. That's why we are debiting shop fittings and we are crediting bank. What about the other $26,000, which is on credit? It's still being added to the cost of the asset, therefore assets are going up, and we debit shop fittings by $26,000. The GST of $3,000 is something that is an asset for us now. That's why we are debiting it, because this is something we can offset against the GST that we have collected when we want to calculate the GST settlement that we need to send to the ATO. And we are crediting other payables by $29,000 because this refers to an obligation for the business, which is a current liability. And that $29,000 is recorded in the current liability as other payables to BFIT, which reflects the amount owed on the shop fittings, and that is the cost of $26,000 plus an additional amount of $3,000 for GST. Okay? So just to simplify, the total cost including GST would have been $33,000. $4,000 has been paid in cash, which is why we are crediting bank by $4,000 and we're debiting shop fittings by $4,000. And the remaining $29,000 out of the $33,000 is what is split into the cost of shop fittings as $26,000 and GST clearing as $3,000, with the total amount of $29,000 being a present obligation and treated as a current liability or other payables to BFIT. All right. Excuse me. So let's move to transaction number 6. Stock that cost $30,000 plus GST was purchased on credit from Exotic Gardens Limited. So we have purchased inventory of $38,000 at cost, and the GST would have been 10% on $38,000, which is $3,800. So if I was to journalize this, let's say, we would be debiting inventory by $38,000. We would be debiting GST clearing by $3,800. Again, the reason we are debiting this is because we can offset this when we do the calculations for the GST settlement, and we credit accounts payable to Exotic Gardens by $41,800, which represents the present obligation of the business for the inventory and the GST combined. So this is going to the current assets section. This is also going to current assets section at the moment because we're debiting GST clearing. This is an asset for the business because the business has paid GST, which it can claim and offset against GST collected. And then we're also increasing the current liabilities for accounts payable to Exotic Gardens of 41,800. What about the last transaction? Stock was ordered for $15,000 plus GST from Far East Traders in Singapore. Delivery is scheduled for 25 June. Right, so we have ordered stock. We haven't got the stock yet. So if we haven't got the stock yet into the business, given that the delivery is on 25th of June, we cannot record this in the books of the business because this wouldn't make sense and this would be wrong. So therefore, you have really nothing to do in this case. This is just a memo which says that you've ordered some inventory which is coming on 25th June. But given that today we are at 1 June, we don't have to worry about it. All right, so let's prepare the classified balance sheet. Okay, so I've already done this for you, but I'm going to explain each and every line. All right, so as you can see, we discussed the accounting question at the beginning, which is assets equal to equity plus liabilities or capital plus liabilities. Total of assets equal to total of capital plus total of liabilities. All right, so we have the current assets and we have the non-current assets, and then we have current liabilities and non-current liabilities, and then we have the owner's equity. So starting with the first current asset for bank, which is $46,500. So where did we get 46,500 from? Okay. So let's reflect on what we have done. First of all, I'm starting with $40,000, which refers to the initial deposit that we have made in the first transaction. If you remember, a check for $40,000 from Chris Stone was paid into the business bank account. Then transaction number 2 refers to the loan that was received in the business bank account, and that is $20,000. Then transaction number 3, which refers to the rental agreement. And if you recall, it was 9,500 in total, which we have paid, and that is why it's in minus here. It was 5,000 for prepaid rent, 500 for GST paid, and 4,000 for security bond. And altogether, this tree makes it 9,500 in total. And the reason this is subtracted here is because we have paid for everything at 1st of June 2014. And the next one refers to the shop fittings where we had paid partially, and that was $4,000 in cash or using funds from the bank account. That was transaction number 5. And you can see I've included minus 4,000 to reflect that it was an outflow. And once you find the net amount, you get $46,500 as the available bank balance. And that is what we have to include here. So bank of 46,500. Then we have inventory of 38,000, which is simply coming from the transaction number 6, where we purchased inventory at a cost of 38,000. There was no other inventory. Do you remember that the last one had nothing to do really because the inventory wasn't delivered and it will be delivered on 25th of June. So the only inventory is from transaction number 6 of 38,000, prepaid rent of 5,000, I believe you remember. And the next thing I've kept here is the GST clearing, which is a current asset, given that whatever GST we have dealt with at the 1st of June 2014, everything was what we paid. We didn't really collect any GST because we haven't made any sales. It's just the first day of business. All right, so what's the amount for GST clearing in this case? And why is this an asset? The reason this is an asset is because we have only paid GST so far, which we are yet to offset against all the GST collections, mainly from sales. So we have paid $500 of GST on rent, which was calculated at 10% of $5,000. And then we also owe GST on the inventory purchase. If you remember the inventory, we purchased was worth $38,000 based on transaction number 6. So the GST will be calculated at 10% of 38,000, which is 3,800. And we also have GST on shop fittings, which had a cost of 30,000, and the GST being 10% will be 10% of 30,000, which is 3,000, and altogether you get $7,300. This refers to GST that we have paid or will be paying using our funds in the bank account, and this $7,300 is a current asset for the business at the moment because the business has this reserve within the GST clearing account, which it can use to offset any GST that it collects on sales at some point in time in the future. Okay, so that is why GST clearing of $7,300 is a current asset here. Excuse me. So let's look into the non-current assets. So you remember the security bond that we will get back at the end of the 3 years of rental agreement, which is 4,000. Motor vehicles that we have contributed at fair value of 24,000, and shop fittings we have purchased at original cost of $30,000. Altogether, this tree, together with the total of current assets, gives us $154,800 as the total of assets. All right, so let's look into current liabilities. So accounts payable is 41,800. This comes from the inventory. So you have accounts payable of $41,800, and that is because of the cost of the inventory of 38,000 and the GST of 10% applied on 38,000, which is 3,800. Together, these two making it $41,800. And this hasn't been paid for yet because the inventory has been purchased on credit. Then we have other payables for BFIT, which is $29,000. And that is called an other payable because it's an accrued expense other than inventory purchase, which is referring to the purchase of a non-current asset. Then we have the short-term loan repayment due in the next 12 months of $10,000. And altogether, this tree added up gives me 80,800 as the total of current liabilities. Then we have the non-current liabilities section, and we have the loan repayment from month 13 to month 24, and that is $10,000. And under the owner's equity, we have total capital of $64,000. How did we get total capital of $64,000? All right, so we started with $40,000 initial capital based on the first transaction when Chris deposited $40,000 into the business bank account. And then we're adding $24,000, which refers to the additional capital contribution for motor vehicle. And there's really nothing else. And together, this two makes it $64,000 in total. That is where the capital of $64,000 comes from. And when you add this capital with $10,000 and with $80,800, you should get $154,800 in total, which is what's happening. So total assets equal to the total of equity plus the total of liabilities. So I should have written total equity and liabilities here, just to make this clear. That's how the accounting equation mainly works. Okay, so that's all for today's lesson. I believe you found a lot of value in this content. Make sure to like and subscribe to this channel, and I'll see you in the next lesson.